Picture a village that became wealthier than every kingdom surrounding it. They didn't win a war, uncover hidden gold, or invent a new trade route. They just sat perfectly still, doing almost nothing at all for 30 years. While the villagers quietly tended their fields, the surrounding kingdoms operated on frantic, manic energy, constantly scheming and fighting to capture more wealth. That quiet village is the ultimate lesson for millions of Americans who sit down every year, stare at an investment app, and try to figure out how to grow their savings. The answers they find usually look incredibly complicated. We are handed exotic trading strategies, funds with names that sound like encrypted passcodes, and the relentless promise that if we hire the smartest people in the room, we can beat the rest of the market. A completely different approach arrived in 1976. An investor named John Bogle launched a new kind of fund. It stripped away all the complex strategies and simply aimed to match the stock market's performance, rather than beat it. Wall Street openly laughed. Critics called the idea un-American. Bogle hoped to raise up to $150 million to get his project off the ground. He scraped together barely $11 million. The greatest threat to the financial establishment came directly from the audacity of a system built entirely around accepting average returns. To see why the industry panicked, return to our Golden Valley. Imagine a lone farmer watching the kingdom's self-proclaimed wizards ride past. They charge massive sums, promising their kings they possess a secret ability to handpick the absolute best crops in land. Translate to the real world, and those kingdoms look like this. Armies of analysts, portfolio managers, and fast-talking brokers burning through staggering amounts of money and human effort to outmaneuver each other. Instead of hiring a wizard to pick the best individual spots, our farmer does the exact opposite. He buys a tiny, unmanaged sliver of every single pasture, orchard, and farm across the entire valley. Before Bogle, the entire financial system rested on a single, highly profitable premise. If you pay the right experts enough money to actively pick your stocks, they will consistently find the hidden gems and outperform everyone else. Managers pointed to endless, overwhelming streams of market data and insisted that only they had the specialized knowledge required to decipher it. That supposed expertise came at an astronomical price. Elite hedge funds typically locked in a structure where they took 2% of an investor's total money every single year, plus 20% of any profits they generated. This chart shows the massive gap in everyday costs. Traditional, actively managed equity mutual funds carry an average expense ratio around 0.64%. By stripping out the expensive human stock pickers, index funds dropped that average to an almost invisible 0.05%. Fast forward 30 years for a family saving for retirement, and that tiny percentage gap compounds aggressively. The active management fee quietly siphons off a massive chunk of their lifetime wealth to pay for those experts. The steep fees flowing to Wall Street were not actually buying guaranteed superior performance. They were acting as a massive, heavy tax levied on the public in exchange for the illusion of control. Bogle hadn't guessed at this inefficiency. The mathematical proof had been sitting in his hands since 1951, when he wrote his senior thesis as a scholarship student at Princeton University. This insight originated far from the shouting of a trading floor. It was carefully typed out in a quiet dorm room by a college student barely into his 20s. His research uncovered a fatal flaw in the industry's math. When you looked at a long enough timeline, the vast majority of highly paid mutual fund managers consistently failed to outperform the broader market averages. The financial industry had built empires on the premise of beating the market. Confronted with a mathematical reality that proved they couldn't, the establishment actively ignored the data for 25 years. Finally, Bogle forced the issue. He founded the Vanguard Group in 1974, and 2 years later launched the first index investment trust, hardwiring his college thesis into a real fund that tracked the S&P 500 with zero active management. Back in the Golden Valley, our farmer had firmly planted his flag. By rejecting the wizards, he claimed ownership of a sliver of the entire landscape. The surrounding kingdoms looked down at his tiny $11 million experiment and sneered. They had no idea they were looking at their own obsolescence. For decades, a quiet divide persisted in the financial world. On one side stood the wizards, elite professionals who argued their market timing skills were irreplaceable. On the other was the farmer, the investor who ignored the noise and simply bought tiny slices of the entire valley, year after year. In 2007, this long-standing debate moved from theory to reality. Warren Buffett, the world's most successful investor, offered a $1 million wager to prove his point. Ted Seides of Protégé Partners accepted. He represented the active side, a world of brilliant hedge fund managers who spent every waking hour running computer models and analyzing markets. For this exclusive expertise, they charged their clients enormous fees. Buffett's side was the opposite of exclusive. He chose a boring, unmanaged index fund that required no human intervention and simply mirrored the 500 largest companies in America. The bet was a test of a single, difficult question. Can the highest concentration of human intelligence and constant trading action actually overcome the cost of its own existence? The timing was brutal. The bet began on January 1, 2008, dropping both philosophies straight into the worst financial crisis in a generation. At first, the hedge funds seemed to prove their worth. As the market spiraled, the actively managed funds lost 23.9%, a significant hit, but far better than the passive index, which plummeted 37%. The crisis spared no one. Whether managed by wizards or left to the farmer, portfolios across the entire economic landscape were severely damaged. But the active managers' early lead hid a structural reality. Even as they lost their clients' money, they continued to extract their expensive management fees. When the recovery finally began, the passive index fund, distributed across the entire corporate landscape, started to regrow automatically. It didn't need a manager to tell it when to return to the sun. It simply moved with the market. The hedge funds had successfully softened the blow of the crash, but that safety came with a recurring bill. As the recovery gained momentum, the price of that protection was about to be put to a much longer test. The index fund delivered a 7.1% gain, while hedge funds averaged 2.2%. Compounded, the index returned 99%, while active funds returned 24%. In cash, the passive fund profited $854,000, while hedge funds generated $220,000. This wasn't because the managers were incompetent. Many of them were the most brilliant minds in their field. They were defeated by financial friction, the inescapable mathematical drag built into the active model. First, the management fees. These are large, non-negotiable costs charged simply for participating in the fund. Next are the execution costs. Every time a manager makes a move, the act of trading itself generates fees that quietly chip away at the total capital. Finally, the taxes. Frequent buying and selling triggers short-term capital gains taxes, a burden that passive funds largely avoid. By the end of the decade, the complex, highly guarded kingdoms of the wizards had barely grown. Meanwhile, the simple, distributed approach of the farmer had nearly doubled his wealth. Buffett's wager proved that in the mechanics of long-term wealth, the friction of constant action will almost always be outpaced by the quiet math of patience. You might look at a strong decade for index funds and assume the market was simply being kind to passive investors. A skeptic could argue it's a short-term anomaly or a lucky stretch. To test that theory, we need to look at the scoreboard, specifically the 2024 SPIVA scorecard, which acts as the definitive measure of how active managers perform over the long haul. This diagram maps out 22 different U.S. equity fund categories over the 15-year period ending in December 2024. Watch the board. Over 15 years, every single category flips red. In 0 out of 22 categories did a majority of active managers outperform. Large companies, small companies, growth stocks, and value stocks. Not one single category where most of the professionals won. This widespread failure reveals a systemic flaw inherent to the entire equity landscape, reaching far beyond any specific market segment. This proportional area chart breaks down the data for the year 2025. It isolates a massive 79% block of active large-cap funds that underperformed the S&P 500. Pulling back historically, placing that next to the 65% failure rate from 2024 ranks 2025 as the 4th worst year in the scorecard's history. Imagine a quiet farmer tending a boring, steadily growing field of index funds, while in the distance, 8 out of 10 wizards, the active managers, are failing to cast the right spells to beat the market. Expand the clock to a 10-year view ending in June 2025, and roughly 4 out of every 5 active managers couldn't survive and keep pace with a strategy that requires absolutely no stock-picking skill. As time horizons extend, the performance of active management degrades consistently. Time itself is the ultimate enemy of the active manager. But there is a detail entirely missing from the performance data most people read. The funds with the absolute worst performance eventually vanish from the historical record. This diagram illustrates the total pool of domestic stock funds over a 20-year period ending in December 2024. Watch the dataset. Nearly 64% of those domestic stock funds gray out and dissolve completely. When an active fund performs terribly for a long stretch, the fund company often closes it or merges it into a better performing fund. The bad track record vanishes, artificially propping up the industry average. It is exactly like a defeated wizard slipping away from the castle in the dead of night. By morning, nobody remembers he was ever there to lose the battle. Because the absolute worst performers are actively erased from history, the real failure rate of active management is significantly higher than the already abysmal headline statistics show. Back in the valley, half the kingdoms relying on active wizards are now abandoned ruins. Meanwhile, the farmer's tiny piece of everything continues to flourish. Behind this widening gap lies a hidden mechanism of wealth extraction, the stark disparity in management fees. Index funds charge 0.11%, while active funds charge 0.60. On a $500,000 portfolio, that's $330 versus $3,000 yearly. Over 20 years, this fee penalty compounds into a $29,000 gap, regardless of margin performance. This is money taken directly from ordinary Americans' retirement savings. The active management industry survives through guaranteed fees, extracting wealth regardless of its performance in the markets. In May of 2026, the structure of American investing reached a new milestone. For the first time in history, the total assets held in passive index funds surpassed those managed by active stock pickers. This chart shows the scale of that shift. According to the Investment Company Institute, index funds reached $21.8 trillion, overtaking the $18.7 trillion held in actively managed funds. These trillions represent the primary destination for American wealth. The journey to these numbers began in 1976. When John Bogle launched the first index fund, he managed to raise just $11 million. At the time, the industry dismissed the concept as Bogle's folly, doubting it could ever compete with professional stock pickers. The strategy that eventually grew into trillions of dollars is built on a simple mechanical premise. An S&P 500 index fund does not try to outsmart the market. It simply owns shares in all 500 companies in the same proportion as the index. You buy a small piece of everything, minimize costs, and wait. Data from the last 50 years shows that the S&P 500 has produced a negative total return only 10 times. This means that in roughly 4 out of every 5 years, the total value of the market grew. While financial professionals often argue that active management is necessary to navigate volatile periods like elections or trade wars, the data suggests otherwise. During the market gyrations through June 2025, Morningstar reported that active funds struggled to beat their passive counterparts, failing to provide the protection their higher fees promised. In times of market chaos, the evidence suggests that security comes from patience rather than paying for frequent reactive trades. For an investor looking at their own savings, the strategy relies on a few core mechanics. First, understand the basket. Buying one share of an S&P 500 index fund gives you instant ownership of a tiny slice of Apple, Amazon, Walmart, and hundreds more. Second, manage costs. A 0.5% fee difference becomes a compounding drag, removing tens of thousands over 30 years. Third, respect the timeline. As the horizon lengthens, the probability of an active manager outperforming drops, flatlining after 15 years. Fourth, prepare for the psychological challenge. When markets crash, human instinct creates a powerful urge to sell and avoid further losses. Investors who sold during the 2008 crisis or the 2020 collapse missed some of the fastest market rebounds in history. The strategy only functions if the investor remains in the market through the downturn. Fifth, recognize where active management still holds value. In less liquid areas like real estate, fixed income, or emerging markets, professional managers often find opportunities that index funds might miss. However, for the large-cap U.S. stocks that form the core of most retirement portfolios, the statistical advantage remains firmly with the index approach. Setting up the plan is a mechanical process. Open an account, choose a broad market index fund, reinvest the dividends, and contribute regularly. But the ease of the setup shouldn't be confused with the difficulty of the execution. Holding a portfolio through a 37% crash requires a level of emotional discipline that no fund manager can provide. This discipline is the primary requirement. The index fund makes the market accessible, but the investor must provide the emotional control to stay the course. Wall Street looks different today. Traditional firms that specialized in picking stocks have merged or consolidated as assets move toward lower-cost options. Many of these institutions struggled to justify their fees as their performance records failed to keep pace with the broader market. Paul Samuelson, the Nobel Prize-winning economist, viewed the invention of the index fund as a major milestone in financial history. Samuelson compared the index fund to the wheel, the alphabet, and the printing press. To understand that comparison, you have to look at what the fund actually did for the average person. It took a complex, intimidating corner of the financial world and made it accessible to anyone, from a truck driver in Texas to a student with $50. It removed the need for a secret formula or a high net worth. Near the end of his life, John Bogle reflected on the institution he built. He noted that his only regret about money was not having more of it to give away. Bogle's career was defined by a belief that ordinary people deserved a fair deal. He designed a system where success was measured by how much value stayed with the investor rather than how much was taken in fees. Index investing is often described as doing nothing, but that description ignores the effort required to stay the course. It requires an active choice to ignore market noise and trust mathematics over the urge to chase trends. In a system that rewards constant action and reaction, mastering the ability to stand still is the ultimate form of bravery.